Again, sustainability is a core module in the Cambridge Master of Accounting program, something that all the students take. And so today we're going to talk about sustainability reporting. I'll give a brief overview on what the topic means and recent developments in this topic and how we approach this in the Master of Accounting program. And then I'll talk about the program. So we'll spend most of our time today talking about sustainability, and then towards the end, I'll give a brief overview of the Master of Accounting program and talk about the admissions process. And then we'll have time for Q&A at the end of the session today. If you have any questions as we go along, please feel free to type those in the chat. And we will, again, likely take those at the end of the session today. My name is Michael Willis, and I'm the director of the Master of Accounting program. And a bit about the Master of Accounting program before we jump into sustainability. So the Master of Accounting program, while it may sound like a technically oriented program, this is a leadership program, and it's designed to train decision makers, not technicians. And our curriculum is focused on enhancing our students' skills in leading innovation in accounting and finance roles. So it's designed for students who want to change their roles or change how their current roles function. It's a part-time program. We'll say more about the structure a bit later, but it allows students to continue working while they study and to incorporate what they learn in real time in their work. And we also designed the program to support career transition paths such as accounting or consulting firm partnership, the CFO or controller career path, financial or market regulatory positions in climate or social related financial disclosure, and finance and accounting public policy roles, among others. So let's jump into sustainability now with that overview of the program. Just sampling some headlines from the past few years related to sustainability and sustainability reporting. Here's one from CPA Australia: reporting on climate change risk, accountants will be needed. Hermione Hudson from PwC UK, the head of audit, says measuring climate change is audit's vital task. CPA Canada, related to sustainability, says we absolutely must wrap our minds around this. And then the ISSB, some of you may have heard of the International Sustainability Standards Board. We'll say more about them in a moment. The ISSB aims to put an end to fragmented sustainability standards. So plenty of news these days around sustainability and sustainability-related disclosures. But first, let's just give a brief overview of the current financial reporting ecosystem. And some of you are working very closely and deeply in accounting and are very familiar with this. But I think it's helpful to orient ourselves to how information flows now in the current financial reporting system. So we have firms, and those firms have lots of transactions and lots of estimates and lots of forward-looking information. And then there are entities outside of the firm that would like information about what's going on inside the firm. And those could include current equity investors or potential equity investors. They're trying to allocate their capital, so they want information about risk and expected cash flows in these companies. Creditors would like information, or potential creditors would like information about companies to make the credit decision. They'd like to know about default risk. Competitors might like information, customers, suppliers, all these entities outside of firms would like information about what's going on inside the firms. And so around the world, most countries have decided that it's in the best interest of the economy for at least some firms to be required to make regular disclosures. And those disclosures take the form of financial statements with the accompanying footnotes. So firms take all their transactions and all their information, and they use accounting standards, which is a set of rules and principles that they use to prepare their financial statements and then disclose those. Sometimes they publicly disclose those if they're required to. Sometimes they just disclose them to certain parties. But those accounting standards are developed by standard-setting bodies. The International Accounting Standards Board sets international financial reporting standards. The United States has its own accounting standards setter, the Financial Accounting Standards Board, and their own set of accounting rules. But there's a problem here, which is that the firms prepare their own financial statements, and we can see intuitively how they might have an incentive to misstate or overstate or understate certain things in their financial statements to make themselves look more attractive to equity investors or creditors or whatever. So we might have some issues about trusting financial statements prepared by the firms themselves. So a number of mechanisms have evolved to enhance our trust in financial statements: regulatory enforcement, boards of directors, auditors, audit regulators, private litigation. These are all designed to strengthen our trust in financial statements. And then outside of these mandatory disclosures, companies make voluntary disclosures. They can tell you whatever they want in a press release, or they can give different metrics in their financial statements just in a voluntary manner. They still might be responsible for lying to you, but they're free to disclose whatever they want alongside of the mandatory disclosures. So a couple of stars here on this graph. First, next to firms. Which firms are disclosing here? Usually firms that have public securities trading in a country are required to make public disclosures. Sometimes it's larger firms or firms considered to be public interest firms. And then on the other side, we have which equity investors are we prioritizing here? Because investors are different in their preferences. Another key around this whole financial reporting ecosystem is the idea of materiality. And materiality is a more technical accounting word. It's really important. And the current definition of materiality is this: information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions that primary users of general purpose financial statements make on the basis of those financial statements. So what information needs to go through this disclosure process? It's what's material. And what's material is stuff that it was omitted or misstated or obscured. It would change the decisions of investors, creditors, etc. Okay, that's the way we currently think about financial reporting at a really high level. So now let's switch over to the sustainability space. And when we're talking about this, we kind of have a lot of terms, but these terms have some overlap. There's no sharp, clear definitions around sustainability related terms. So I'm going to give you a few terms here, some definitions I like that we'll work with today. Corporate social responsibility. This has been talked about for decades. And this is a term that kind of came out of the academic literature. Corporate social responsibility is corporate activities and policies that assess, manage, govern a firm's responsibilities for and its impacts on society and environment. So this is putting business in the context of a society, of an environment. And what are the business's obligations to society and the environment? So this is going beyond the obligation to investors, the obligation to owners. Sustainability reporting usually refers to the measurement, disclosure, and communication related to corporate social responsibility or sustainability activities. So whatever activities have to do with a firm's impact on society and environment. Slightly different would be sustainability related financial reporting. This would be measurement, disclosure, and communications of how CSR or sustainability activities impact a firm's future financial performance. So this is closer in spirit to the traditional financial reporting that we talked about on the previous slide, where this type of reporting is thinking about financial performance. We're using that similar idea of materiality. What gets disclosed is what's important to investors. But maybe there are CSR sustainability related activities that inform that financial performance. And then ESG is another acronym that we see quite a lot of. This term seems to get used more often in the context of more traditional investors and criteria that they use to optimize their portfolio based on their preferences. This is S&P's definition of ESG, a broad range of environmental, social, and governance criteria on which companies are measured. Through ESG investing, market participants consider in their decision-making the ways in which environmental, social, and governance risks and opportunities can have material impacts on companies' performance. So again, here in ESG, this ESG investing idea, at least in the S&P's definition, investors are using ESG information to measure companies' potential future financial performance. Okay, so this is an additional source of information in their investment decision. All right, these are how some of these terms are typically used. So what about sustainability reporting? What's been going on in this world? Well, for years, for decades, there have been a large number, actually hundreds of voluntary sustainability disclosure frameworks that have been prepared by nonprofit organizations, sometimes in collaboration with government entities, sort of loosely, to put together a disclosure frameworks that firms can voluntarily use to tell their story about sustainability. So we've seen things like the Climate Disclosure Standards Board that developed some disclosure frameworks around how do firms disclose climate change related information. We have the SASB, the Sustainability Accounting Standards Board, that developed a set of sustainability related financial reporting standards, and hundreds of frameworks that were out there that firms could voluntarily use, but they weren't typically mandatory. There was some limited mandatory disclosures of sustainability related items, different countries in different areas around the world, but not much, and it was not nearly as well developed as traditional mandatory financial reporting. So a highly fragmented sustainability reporting ecosystem based on voluntary frameworks that firms could choose to use to tell their story or not. And as a result of this, information that's not disclosed using a common set of standards can be difficult to interpret for investors, because investors like to compare different companies. And if one company uses one framework and another uses another, it's difficult to make that comparison. Okay, so do we need sustainability reporting standards or sustainability related financial reporting standards? Do we need a common set of standards, and perhaps should be mandatory for some firms? Well, there's a difference of opinion on this question. So Hans Hugervorst, who was the chair of the International Accounting Standards Board, this was in a speech actually he gave at Cambridge at St. John's College at a accounting conference. In an ideal world, there would be no need for sustainability reporting. So what he means by this, coming from the point of view of a traditional financial reporting standard setter, is this: that if we're thinking about firms who are acting in ways that are exploiting vulnerable communities, or they're exploiting the environment, this is what we call a negative externality in economics. It's consumption that is not priced in for the firm. And the way we typically think about addressing an externality is through taxation or regulation. So Hugervorst is saying, ideally, governments can regulate bad behavior on the part of firms through taxation, through regulation, and deal with those implications that way. And then whatever financial implications arise out of that get reported through the traditional financial reporting system. So if there are financially material taxes or financially material regulation, that gets measured, that gets reported through liabilities, through changes in P&L, based on existing financial reporting standards. So that's one argument. But that doesn't seem to be the argument that sort of won the day here in the development of sustainability reporting standards. A lot of investors feel that current financial reporting standards are not sufficient to capture all of the sustainability related information that's relevant for them in allocating their capital. So as we begin to think about this question of sustainability reporting, it's important that we're clear on the goal. What's the potential goal or outcome of sustainability reporting? Are we thinking about capital markets outcomes? Are we thinking about impacts on investors of having a richer set of ESG or sustainability related information? If that's the goal, then what are we looking for? Are we looking for greater market liquidity, a lower cost of capital, essentially a reduction in information asymmetry? Would this then result in improved capital allocation decisions? So this kind of outcome is one that we associate with the development of more traditional financial reporting standards, that as they were adopted, it increased trust, decreased information asymmetry, and increased market liquidity, and therefore improved capital allocation and pricing. Okay, well, some people seem to think, and entities seem to think, that maybe the ultimate goal of sustainability reporting is to influence firms' real behavior. Maybe through a different disclosure environment, firms will actually change what they do and act better. This one is, I think outcomes here are much more difficult to predict. We can expect a lot of different effects across firms, across industries, across countries, in how firms react to mandatory sustainability disclosures. There will be intentional and unintentional consequences here, and it's very difficult to say what's going to happen, what the world will look like if we think about designing sustainability reporting to change firms' behavior. And also, we need to keep in mind that there's a cost of disclosure, that every new disclosure regulation imposes a cost on firms. It's costly to get the data, to disclose the data. It could reveal proprietary information to competitors that could jeopardize or impair competitive advantage. It's costly to investors to process information as well. Okay, so keep these ideas in mind as you're sort of thinking about and consuming news about sustainability reporting in general. Okay, so what I'd like to do now is focus on a particular area of sustainability reporting, because it's the area that's gotten the most attention in the last 5 years or so, and it's the area that's been that the disclosure standards have developed most quickly, and they have developed very quickly. And this is climate. And again, this is just one slice of the ESG sustainability disclosure picture. I'm zooming in on climate because it's gotten the most attention and the most momentum, and it's not even close. So climate is considered by many countries, by many people, by many entities, a really urgent problem in the world, and a particularly difficult problem to tackle because it's an externality that's a global externality. So the actions of one country could impact the whole planet. So the typical approach to externalities, regulating them, doesn't really work with climate change, because if country A regulates climate and emissions really strongly, but company B doesn't, then we don't really get anywhere. It's also an externality where the impact flows to the future. We don't see it. We don't see it in front of us. Most people don't see it in front of us. The impacts of climate change. If you're looking, of course, you see things and can link them to climate change. But the really severe consequences will flow to the future, not to the present. Anyway, the current sort of projections and scenarios around climate change are not looking great for limiting the global average temperature increase to 1.5 degrees Celsius, which was the Paris Agreement goal. So this effort to develop climate-related disclosures really kind of got some momentum around 2015, with support from Mark Carney, who was the former governor of the Bank of England, and some other key players in the space. The argument made by Carney and some others, and he gave a speech called "The Tragedy of the Horizon," which I recommend is interesting reading if anyone's interested in the climate space. Carney's argument was that climate change is a risk to the global financial system. But by the time financial stability is affected by climate change, it may be too late. So climate change could potentially, under many predicted scenarios, would disrupt things like agricultural land, so rising sea levels, fish populations, labor market conditions, forced migration, supply chains, have serious economic disruptions economy-wide and globally. So that's why it's a potential risk to financial stability. Well, we have market mechanisms to try to enhance financial stability. We have insurance providers, for example, who can underwrite risks. And that's how the financial system manages a potential catastrophe and uncertainty. But in order to price risk, insurance underwriters need good information to assess the probabilities of given events. And the argument is current disclosures around the impact of climate change on businesses' operations and strategies are insufficient. So market participants don't have enough information to insure themselves against different climate-related outcomes. So what Carney proposed is a unified approach, some set of disclosure standards that firms could use to disclose potential impacts of climate change on their company's own strategy and operations. And if that information were available and it were trustworthy, market participants could insure themselves against risks, and companies could take actions to strengthen their resilience to different climate-related scenarios. That's the rationale for developing a climate-related disclosure framework. And so in 2016, we have the Financial Stability Board, which is a group of G20 finance ministers, convening the Task Force on Climate-Related Financial Disclosures, or TCFD. Okay, these were global experts that were tasked with developing climate-related financial disclosures. 2017, the task force released its recommendations. And this is how they described the recommendations that they published. The recommendations describe information that companies should disclose to help investors, lenders, and insurance underwriters better understand how companies oversee and manage climate-related risks and opportunities, as well as the material risks and opportunities to which companies are exposed. Okay, so this fits into the plugs into the traditional financial reporting ecosystem that we talked about, where what's important is what's financially material for investors, but we're just thinking about climate-related issues and how those might impact companies. The idea behind TCFD is this, that companies assess risks and opportunities related to climate change. And they do so in their strategic planning and risk management at the board level, at the C level, throughout the organization. They assess these risks and opportunities, and these could be things like, under a particular scenario, what does the labor market look like? What does our supply chain look like? How resilient is our strategy? And then they consider the financial impact of those risks and opportunities. And then they disclose that financial impact, what the financial impact might be on the income statement, the cash flow statement, and the balance sheet. Okay, so this is very forward-looking. It's looking at different climate-related scenarios, how the states of the world, how the world might look in the future, considering potential financial impact under those scenarios, and then making those disclosures. Okay, so it's a very different way. It's a very different way of looking at financial reporting and financial disclosures. It's connected with traditional financial reporting because the communication is done in part in what are the impacts on financial statements and financial items, but it's much, much broader. And to really implement TCFD, it involves a really enterprise-wide effort, and is not sort of a financial reporting task or an accounting or compliance exercise. Okay, so it's a really serious look at a company's risks and opportunities and strategic planning. That's the spirit of the TCFD. Now, the reason why we're talking about this is because it's gained so much momentum globally. So for example, the UK has now made it mandatory for companies to make climate-related financial disclosures. So the largest, about 1,300 or so firms in the UK, so not just firms that have publicly traded securities, but larger firms that are private as well, are now required to make TCFD aligned disclosures. The EU has also made these mandatory. Japan, New Zealand, and a few other countries around the world have made TCFD mandatory. The United States as well has warmed to this idea. So in the United States, the Securities and Exchange Commission is the financial regulator there. And the SEC earlier this year released a draft proposal to require companies to make TCFD aligned financial disclosures, which is a pretty significant, very significant move by the SEC in the United States. The proposed rule was released and the public comment period has passed. So in the US, they're revising, considering revisions to the proposed rule, and we expect to hear more about the process sort of towards the end of the year. Okay, so TCFD, some significant global momentum. Okay, so beyond the TCFD and climate approach, in early 2021, we had an announcement from the IFRS Foundation. The IFRS Foundation is the parent organization of the International Accounting Standards Board, which is the standard setting body for the world minus the United States, essentially. The IFRS Foundation announced that they were creating a new standards board, which if you're not sort of in the accounting space, that doesn't sound really exciting or interesting. But inside the accounting space, it's actually really, it's a really significant development in the standard setting world. Especially a new board that falls under the IFRS Foundation that's sort of parallel to the IASB. In any case, so the announcement was made that that this board would be developed, and then there was some speculation about what kind of approach would this new board take? Would it develop financial reporting standards that were related to sustainability, that were aimed at investors and informed investors' decision, or would it take a broader approach and consider sustainability issues related to businesses' impact on society or on communities or on humans, and more broadly speaking, that weren't necessarily financial impact? So in this announcement in early 2021, the IFRS Foundation clarified that the new board would prioritize investors and their assessment of enterprise value. So they're following the more traditional financial reporting framework, but bringing in sustainability-related standards. They announced that the scope of their work would be sustainability issues broadly, but they would prioritize climate. So they would begin by developing climate-related standards and then broaden out to other sustainability-related items. The board announced that they would build on the Task Force for Climate-Related Financial Disclosures, so the TCFD that we talked about, would inform the new climate standards from the ISSB, and that they would, again, move out to broader sustainability items after trying to tackle the climate disclosure issue. So the current status of the ISSB, the board is in place. Emmanuel Faber from Danone, the former CEO of Danone, is the chair of the ISSB. So they've issued 2 draft standards. One is a sort of general, more conceptual view of what sustainability-related financial information means and what disclosure is relevant there. That's where their approach to materiality is set forth. Again, prioritizing investors in the decision of assessing enterprise value. And the framework of disclosing governance around sustainability items, strategy, risk management, and then targets and metrics. This is a framework that we saw in the TCFD, and that's kind of what ISSB has adopted as well. So the standards that they publish, we expect them to follow these high-level principles. So the first standard that they've put out, the draft standard, is S2, which deals with climate-related disclosures, and that is heavily informed by the TCFD's work. So that's the current status of the ISSB and their standards. And those standards are the public comment period is also passed for those standards. So the board is considering now how to revise them for their the final version of the standards. Okay, now it's important to remember that the ISSB it's just a nonprofit organization. It doesn't have any authority from a government. And so it's going to be putting out these documents, and then it will be up to country level regulators to determine to what extent these disclosures are going to be made mandatory and what types of regulatory enforcement will be put into place to strengthen trust in these disclosures. Could be the case that some exchanges, some stock exchanges around the world make these mandatory to be listed on an exchange. We don't know yet how that's going to play out, how the global adoption of sustainability standards will work. Okay, so another approach. So we talked about the TCFD, we talked about the ISSB, sustainability standards. The EU is taking quite a different approach in their sustainability work. For some time now, for a few years, the European Commission has been working on a proposal for their corporate sustainability reporting directive, which is a big overhaul of their ESG-related disclosure rules. So currently, there's a set of prototype standards that have been published that the EU is considering. And these are much broader than the TCFD that's focused on climate, or the ISSB that's focused on currently on climate-related financial reporting, broadening out to other types of financial reporting. The EU's approach considers under the environment umbrella, climate change, pollution, water and marine resources, biodiversity and ecosystems, resource use, and circular economy. Under the social heading, they have a standard on own workforce, workers in the value. So this would be how the organization treats its own workforce, essentially, how it handles workers in the value chain, other affected communities, consumers and end users, and then under the governance framework, under the governance umbrella, the governance, risk management, internal controls around all these things, and business conduct in general. So there's a standard for each of these areas. So these are much, much broader than what we've seen in the ISSB. Now, these are important as well because the take on materiality is quite different in the EU. So in the traditional financial reporting framework and in the TCFD and ISSB, we're working with what's called sometimes called single materiality, or traditional financial materiality, which is if something is material, if its omission would affect the decision of an investor or a decision maker. So the EU's approach is what we sometimes call double materiality. And the idea of double materiality is that items are material if they are financially material, or if they have an impact on broader society, on the environment, or on people from a sustainability perspective. That's the essence of double materiality. So the standards we're seeing are not just focused from the EU, are not just focused on investors and them measuring enterprise value. They're focused on society as well, and businesses' obligations there. Okay, so we're seeing these two sort of frameworks developing simultaneously on the ISSB, IFRS side. That's focusing on the single materiality framework. On the EU side, the double materiality perspective. The two organizations, the EU's organization, the ISSB, are collaborating. They describe themselves as two interconnected reporting pillars. Not exactly sure what that means. They're both heavily informed by the TCFD on their climate work. One thing that's important to note is that the EU standards that they're developing are going to be very likely going to be mandatory, not only for firms with securities trading on EU exchanges, but any firm that does significant business in the EU. So if, let's say, a multinational firm has an EU subsidiary that's large, and large is defined as either 40 million in revenue, 20 million in assets, or 250 employees, I believe is the latest threshold, they'd be required to make sustainability disclosures under the EU framework, which are very broad. So it's a pretty bold move in the ESG disclosure world. Okay, so that's a bit about what's going on in the sustainability disclosure world. So what we're likely to see here, bringing back the old picture we had from before, what we're likely to see is the ISSB developing IFRS sustainability standards. We're likely to see some countries or areas like the EU developing their own sets of sustainability related standards or requiring TCFD disclosures initially, perhaps broadening out to other sustainability standards. So these standards could take different forms. They could have different prioritization, different views of stakeholders. A really key question is how trust enhancers are going to develop to support this whole disclosure environment. There's a lot of work that needs to be done between where we are now and where an environment where this type of sustainability information is available and trusted. So what does regulation look like around these disclosures? How do boards address it? What about audit? What level of assurance is given to sustainability related information? How do audit regulators think about this? What about litigation, private litigation? How does that work with or work against the provision of this type of information? Okay. So this is the direction that the world is going, and it's been moving very, very quickly in recent years. Okay, so all right. So I could take some questions now on the sustainability topic before we get into the MAcc. So if you have any questions on what we've talked about so far, go ahead and type those in the chat. And I see one that's a question that's related to the MAcc, and I'll take that at the end. Given that there are already multiple reportings out there, the EU taxonomy becoming mandatory for some firms, do you think IFRS approach will still have its place? Yeah, that's really interesting. So we're seeing sort of the EU's disclosure requirements as being kind of a superset, right, of this what the ISSB is working on. So I do think the IFRS approach will still have its place. We're still in early days to see how that evolves, how countries approach sustainability standards, what the standards actually look like, the extent to which the EU and the ISSB will collaborate, and what that relationship is going to be. So I do think the ISSB approach is definitely relevant. I think it still has its place, maybe for companies that are doing business in the EU or EU-based companies. It will sort of be subsumed by what they're expected to do, but a lot can happen. This area is developing very quickly, but what definitely needs to happen is at larger firms that are going to be touched by this, you're going to need to keep your eye on developments globally around these areas, around these disclosures, and be aware of the different requirements in different jurisdictions. So that the sort of, from a compliance perspective, the disclosure task is got a lot more complicated, and it's going to continue to be more complicated. So it's just going to be a kind of a chaotic period for the next few years while we sort of see what's going to stick and what's going forward. Hey, Lucinda, good to see you. What does regulatory enforcement look like at this stage? Yeah, we don't know yet, because we're still working with draft standards, so we don't actually have anything that's finalized really yet from the ISSB. We have some some TCFD is become mandatory in some places. In the in the UK, for example, the TCFD is a comply or explain regulation, which means firms comply with the disclosure, or if they don't, they explain why they don't comply with the disclosure regulation, but then it's up to the market to enforce it. So light enforcement so far from the UK on TCFD, and that's sort of the most advanced one right now, because everything else is just a draft standard. Good source where best practices in implementing the reporting is described. So when we cover this in the MAcc, we go into a lot more detail on this topic, on what does a good disclosure look like, and how to think about weighing strategy versus compliance and these types of things. It's still really early days on what these things look like. So we're all building best practices together in real time, really. And again, this is the type of issue that we're trying in our program to prepare leaders to address and lead through. And on that note, I want to say a little bit about the MAcc program. So the sustainability fits into our curriculum under the heading that I call accounting leadership. So in the MAcc program, we have curriculum around accounting topics, but the focus is very much on leadership and innovation. So when we teach global financial reporting, the emphasis is not sort of learning the technical details of the standards, but understanding the rationale for the standards and how to become an advocate for improved standards. When we teach about strategic performance management, for example, that's the how things get measured and communicated and acted on in an organization, and it's a very strategic leadership focus on developing metrics in an organization and using them in ways that support the mission, the strategy of the organization. Okay, so accounting leadership is an area of the MAcc curriculum. We also have curriculum that is related to people and organizations. So change management, interpersonal dynamics, governance and ethics. We have content around data analytics, so data visualization, predictive analytics, which is sort of machine learning, neural networks type algorithms. And then we talk about analytics applications, all of the ideas around investing in analytics. How do you measure that and make that decision? What are the ethical, cultural considerations around analytics investments? Well, another key feature of the curriculum is the team consulting project, which takes place at the end of the program. Our students work in teams on a consulting project for a client. It's very flexible and takes different directions depending on the student's interest and the client's needs. And then we have electives, and beginning in 2023, beginning with a class that enrolls in 2023, so next year's class that begins next year, electives will be shared with the EMBA program. So we'll have MAcc electives cross-listed with EMBA electives. So our electives around tax and M&A and valuation combined with EMBA's electives around some more topics related to leadership, digital marketing, digital transformation, things like that. And I'll refer you to the website where all of the modules are listed and described, and you can see how they flow through over the program and get a better idea of what we talk about in the MAcc. The MAcc program is 2 years. It's a part-time program, and it's a post-experience program. So our students come to Cambridge for 8 residential weeks over 2 years. So once per quarter, they come to Cambridge. So in September, and then in December, and then again in March or April, and then 8 times over 2 years. They spend a week in Cambridge. And those weeks are pretty intensive, interactive sessions, lots of debate and discussion, case studies. We have college dinners during the week where we go to one of the Cambridge colleges and get together for a dinner there. The really lovely settings. Sometimes we bring in speakers to have conversations with our students, and bring in guest speakers regularly to these residential sessions to hear what's going on in industry. So we've brought in the head of M&A from BP. We've had the former global board chair of PwC talk about audit issues. We have just a couple of weeks ago, we had a senior engineer from Meta actually come out and talk about AI and machine learning and what's going on in that space. So those residential weeks are busy, but they're really interesting. And then in between the residential weeks, our students are engaged in online activities, preparing for the residential visits. So they might be reading case studies online and answering some discussion questions on a discussion board, having some discussions around interesting ideas or developing topics. Could have live office hours with faculty where students can drop in and ask questions about what's going on in getting ready for these residentials. Okay, so that's a bit about the program structure. And again, lots more details on the website. In the 2022 cohort that enrolled this year, we have 16 students. So we expect to grow that in 2023. to mid-20s, 30 students is what I'd expect to see next year. Most of our students have 6 to 10 years of postgraduate work experience. Some have more, some have 20 plus years of work experience, some have a bit less work experience. That's okay. An accounting background is not required. A little over half of our students have some kind of accounting qualification or work experience, but the rest don't. We have students who come from backgrounds in corporate finance and consulting, entrepreneurship and law, public policy, etc. So it's a very professionally diverse cohort. It's also a very globally diverse cohort. We have students from all over the world who come to Cambridge for the MAcc program. So just a few things on the application process. So a common question I get is, am I academically qualified to study at Cambridge? You know, is my university degree good enough? And did I do well enough in my undergrad to come to Cambridge? So here's how we think about academic qualification. So Cambridge University sets some standards for admission to its graduate programs. One way to demonstrate academic qualification is having a 2-1 or its equivalent in your undergraduate degree. The 2-1 is in the UK system, but there's international equivalents for other countries. Or if you have a master's degree or another graduate degree, that demonstrates academic qualification. So maybe someone didn't have a 2-1 in their undergrad, but they did have a master's degree, then they'd be considered academically qualified. Or professional qualifications that are equivalent to a master's degree. So some professional qualifications like an ACCA qualification or ICAEW or a CIMA are considered equivalent to a master's degree. And those could demonstrate academic qualification. And in some cases, applicants might be required to take the GMAT or the GRE or the executive assessment. Most students don't have to take those exams, and we don't require every applicant to take the GMAT or GRE or EA, but that is one way that an applicant can demonstrate academic qualifications apart from undergrad, master's degree, or professional qualification. Now, as a professional program, we're also interested in your professional experience and what you've done. That says a lot about who you are and what your interests are. So we're looking at your work experience, and it doesn't need to come from a particular area. It doesn't need to be related to accounting, but we're looking for your impact. What impact have you had in your work? To speak to this, we ask for 2 references who can address your impact, who know you well enough to tell stories about what you've done in your organization. We look at English proficiency, which is demonstrated through nationality or through English language test. We look at essays. Our essays are ask you about change and your attitude towards change, because change is a really key theme of the program that's woven throughout the curriculum. So we ask you to talk about your work experience with change and how you see change. And then selected applicants are invited to interview with me, and those last for about 30 minutes. They're done via Zoom. The interviews are not technical. It's just an opportunity to talk more about what you wrote in your essays and what your interests are and how the MAcc might support those interests. So those are the keys in the application process. Now, if you are, if you think you might be interested in learning more about the program and you're wondering, is this program a good fit for me? It's really important that our students have enough information to make a good decision about whether they want to do this program. And because the MAcc is unique and there really isn't much like it on the market, it's important that our applicants do understand this. So a great way to understand if this is a good program for you is to submit your CV. So you can book a profile review. There's a link on our website, and you can submit a CV. We'll review the CV, and we'll get back to you with how the program might or might not fit with your background. And then if it looks like there might be a fit based on the CV, then we can arrange a time to have a conversation. You and I have a conversation, an informal conversation, just about how the program might be a good fit for you, and we can talk about your your individual situation with respect to academic background and language and professional background. It's just a conversation designed to help you get a little more information about your particular situation. So that's a great way to get some more information about the program, and that link is on the homepage, and it's also in the chat. Okay, and here's my contact information as well for any questions that you might have. And we have just a few minutes left. I want to be conscious of everyone's time. I know we've got lots to do today. So does anyone have any questions? If you have questions, please feel free to just type those in the chat. And we've got a few minutes now for Q&A. Lucinda, welcome, Lucinda. Lucinda Lee is one of our distinguished alumni who just graduated this year. Lucinda's from Australia. What time is it in Australia, Lucinda?
It's almost midnight, actually.
Almost midnight. Wow.
Like, yeah. But I didn't want to miss the sustainability talk because it's a hot topic right now. And in Australia, and there's been a lot of greenwashing, and regulators are looking to see what they can do in that space.
So, Lucinda, I don't want to put you on the spot here, but I actually do want to put you on the spot here. So, can you just tell us really quickly what you do in Australia and what sort of drew you to the MAcc program?
So I work as a finance business partner at one of the regulators in Australia, which is the equivalent of SEC. It's called ASIC. And as a finance business partner, I'm doing mainly management accounting type roles, financial reporting for different business units internally. So what drew me to the MAcc program was that it's got a lot of focus on sort of leadership as well as new techniques to be used in accounting. So one aspect that I really liked about the program was descriptive and prescriptive analytics. Learned about business intelligence tools, what to do with reports, how to make reports visually appealing. And I'm currently using that in my current role at work. I am creating new reports with business intelligence tools such as Power BI and using Power Query from Excel. And my stakeholders have really liked the improvements in the reports. This all stems from doing the course, actually, being inspired by the course, the MAcc course.
Thanks, Lucinda. Thanks for being here. If anyone else has any questions, please feel free to just type those in the chat. I saw a question earlier just about funding finances. So because we're a newer program, smaller program, we have sort of limited funding available. We do have a few bursaries, though, that you can read about on our website. We have some smallish bursaries set aside for applicants to fit a particular profile or particular set of interests. So those are available. The part-time, program structure has some benefits in that you can keep working while you do the program. But one of the downsides is there aren't as many third-party funders for part-time financial aid as there are for full-time programs. So trade-offs there, but we hope to be able to grow financial support through when Lucinda becomes a billionaire, and other alumni like her, then we'll be able to provide a lot more, right, Lucinda? No pressure.
Oh, if I won the lotto tomorrow, yeah, sure.
Okay.
Definitely.
Okay. This is being recorded, so you've made a commitment. That's actually legally binding.
Yep. Okay, sure. Okay. No worries.
Okay, great, fantastic. Okay, well, if there are no other questions, then if you have anything else that you'd like to chat about, please feel free to drop an email offline or submit a CV. But thanks everyone for your time. See a question here. I want to be a teacher in accounting. How will this course help me? That's a good question. So if you have a question about your own sort of particular background, is this course for me? That's a really common question, because this program is unique. So how do you even start to think about, is this right for me given what I want to do? The best way to get an answer to that question, again, is to submit your CV to the profile review. And then we can look at, what you've done and think about where you want to go, and can the MAcc program help you get there? That's the best way to get that question answered. So I'd encourage you to do that, because it's such a individual question. But we have had educators in the past do the MAcc program, is sort of the short answer to that question. And I think there are some things that could be useful to support that career path. Okay. Okay, great. All right, thanks everyone. Thanks for attention. Thanks for being here. It was great to see you all. Wish you all the best and hope to hear from you soon.